Financial Pickle here. Inflation has been a hot topic lately, and in general it's thought of as the enemy of the stock market. High inflation means lower stocks, and low inflation means higher stocks, right? Well, what if I told you the opposite is generally true? That inflation is actually one of the main reasons why the stock market goes up in the long term, and high inflation generally means higher stocks. And before you write me off as a crazy lunatic, let me present to you the stock market performance of Venezuela, a country that has been plagued with hyperinflation. In just the last year, their stock market is up 373%. Now, of course, the real returns when you adjust for inflation are going to be much lower, but that's not really the purpose of this video. Today we'll be talking about why inflation is generally good for the stock market in nominal terms. So you're probably wondering, if inflation is such a good thing for the stock market, then why have US stocks done basically nothing for 2 years while inflation has gone up? To help answer that, I'll first need to lay a bit of groundwork. There exists something called the risk-free rate, which is the interest rate you can expect to earn on a zero-risk investment. In the US, government debt called treasuries are used for this because there is theoretically zero chance the government will default on their debt. For example, a 10-year treasury currently pays about 4.7%. This is the baseline of what you're guaranteed to earn with your money if you lock it up for 10 years. And if you take on a little bit of risk, then you expect the possibility to earn more. Otherwise, there's no point in taking the risk. This is called the risk premium. Now let's pretend we have a 10-year corporate bond that pays 5.2%, which is 0.5% higher than the risk-free rate. It comes with added risk versus the treasury because there's a chance the corporation won't be able to pay you back. If you buy this bond 1,000 different times in 1,000 different alternate realities, then most of the time you'll make the 5.2%. But sometimes the company might go bankrupt after a few years and you'll make less. So let's just say on average you make 5.1%. This is called the expected return or the expected value. It's the average you can expect to make or lose on an investment or wager each time you do it. And there are ways to calculate it, but that's not really something I'll be going over much in this video. So the expected return on this bond is 0.4% higher than the risk-free rate, and that 0.4% is the risk premium. Stocks have an expected return as well, but it's harder to quantify because there are more variables involved and multiple different ways to try to calculate it. And stocks don't have a maturity date like a bond, so they're compared to a long-term risk-free rate, such as the 10-year treasury. Let's take a look at this hypothetical stock. The price per share is 100 and the earnings per share is 5, which means the PE ratio is 20. And there's another metric that's not commonly used called the earnings yield. It's the earnings per share divided by the price per share. So it tells you what the stock is earning per year relative to the price. And it's actually the inverse of the PE ratio. Hypothetically speaking, if this company was guaranteed to earn $5 per share every year, then they could pay you their 5% earnings yield every year as a dividend, similar to a 5% interest bond. But because it's a stock, you have added risk and added potential rewards. Their earnings could go down or the company could even go bankrupt. But over time, the earnings of the average company go up. It wouldn't be out of the question for that $5 in earnings per share to turn into $10 or $15 after 10 years, which means over time, that 5% earnings yield is likely going higher. And as I said before, calculating the expected return on a stock is quite complicated, but a large part of it is based on their earnings plus the future growth of the earnings. And a large part of that future growth is because of inflation. For this example, we'll assume the expected return is 8%. Which means a 3.3% risk premium above the 10-year treasury. Now, imagine if suddenly everyone's salary, bank account balance, debt, and prices on all goods and services were doubled. Spending habits should theoretically not change at all because your purchasing power is exactly the same. So people would buy exactly the same amount of things as before, but because prices have doubled, that means revenue and profit will double as well. So our $5 of earnings per share becomes 10, our PE ratio goes from 20 to 10, and our earnings yield goes from 5% to 10%. This makes the risk premium on our stock go up quite a bit, which makes it very attractive relative to other investments. So it only makes sense for the stock price to go up because that reduces the earnings yield, which then reduces the expected return, which then causes the risk premium to come back down. All of this is basically what inflation does, but normally it happens in smaller amounts over longer periods of time. But of course there are extreme examples like Venezuela. This is why stocks are such a good inflation hedge. They produce and sell the assets that are being inflated, which directly correlates to higher revenue and higher profit. Now, I did make an assumption earlier that your salary goes up at the same rate as inflation, and that hasn't really been the case the last couple of years where inflation has been higher than wage growth. But that trend has recently reversed. And over the long term, wage growth does outpace inflation, but I'll go over that more in another video. For this video, we'll assume wage growth goes up at the same rate as inflation. So now, let's get into why the US stock market has been relatively flat the last couple of years even though we've had lots of inflation. 2 years ago, the 10-year Treasury was around 1.6%, and for the corporate bond and the stock, I'll just estimate what their expected returns were at the time. Now for a quick history lesson. Shortly after COVID started getting under control, inflation started to increase due to various reasons. In order to combat this increase and bring inflation down to their 2% target, the Fed started aggressively raising short-term interest rates. And their plan has been working, but not as quickly as they originally thought. So now the market expects short-term rates will stay higher for longer because the Fed needs more time to fight inflation. And inflation is expected to remain above their 2% target for longer than previously expected. All of this has caused long-term interest rates to rise, and higher interest rates cause the economy to slow down, which means lower earnings and earnings growth for stocks. And all of that causes the risk premium on riskier assets like stocks to shrink, and it doesn't make sense to take on more risk unless there's potential for more reward. So there has to be an adjustment somewhere in order for that risk premium to get back to a reasonable level. And adjustments have been happening over the last couple of years. First, let's look at the rising long-term interest rates, which caused downward pressure to the stock market. You can actually visualize this if you compare the 10-year Treasury to different stocks. For example, here's a 1-year chart comparing the 10-year Treasury to Coca-Cola. You can clearly see that they have an inverse correlation. So the stock going down doesn't necessarily mean there's something wrong with the company. It could just mean that the price had to come down to have a reasonable risk premium again relative to risk-free rates. The same thing happens with bonds. When interest rates rise, the price of bonds go down so that their yields go up. So in a way, stocks are like very risky bonds, but instead of paying you all of their profit in dividends, they reinvest a lot of it back into the business. And while interest rates were going up the last 2 years, the earnings per share on the S&P 500 has gone up and is now well above the pre-COVID levels, and it's expected to continue going even higher. This has caused upward pressure on the stock market. So the downward pressure of higher interest rates and the upward pressure of inflation and higher earnings have been counteracting each other, causing stocks to go basically nowhere. And because the earnings per share has gone up while stocks have remained flat, that means PE ratios have gone down and earnings yields have gone up, which caused expected returns to go up. And that brings back the risk premium. But again, these expected return numbers aren't real calculations based on what's happening right now. So it's tough to say if everything is fully priced in, and rates could go even higher from here. Now, the big thing about rising interest rates is the downward pressure it causes on the stock market is a one-time thing, but inflation is continuously happening almost all the time, and it's not often that we see any deflation. Things are constantly adjusting higher and higher to a new normal as time goes on. For example, 50 years ago, a new car was around $4,000, and obviously it's much higher now. It just takes people some time to mentally adjust to the new normal, especially now with more inflation than we're used to. So unless prices deflate back to where they were before, then that makes it harder and harder for the stock market to go down to where it was before as time goes on. Because again, those higher prices directly correlate to more revenue and more profit, even if the amount of product sold is the same. So eventually, when interest rates stop going up, that downward pressure on the market will be gone. Then the upward pressure from inflation and rising earnings will finally be able to take the stock market higher. And when interest rates eventually come down, that upward pressure will be even higher. So just the fact that inflation exists is not a bad thing for the stock market. A small amount of steady inflation is actually good for the stock market and the economy, which is why the Fed wants to keep inflation around 2%. But when it starts to move too high or too low, then that usually means something is out of whack with the economy, and the Fed will likely step in to try to bring it back in line. So the Fed raising rates is actually what was bad for the stock market recently. If they didn't do that, then we would likely have higher inflation and higher stocks, but not necessarily a healthy economy. And the Fed's priority is a healthy economy. And as always, nothing I say here is a recommendation for anyone to make any investment decision. Anything can happen, and the market isn't always rational, especially in the short term. So invest at your own risk. That's it for this video. Thank you so much for watching. If you enjoyed it, please give me a like and a subscribe, and let me know what you think in the comments below. Financial Pickle here, keeping you out of the pickle jar.